Hey everybody, it's a new month and it's time for another monthly update on what the Institute for Supply Management economic reports are showing us. I always want to keep up on these to stay aware of what businesses within the industry are all telling us. Basically what their sentiments are. So I'm going to cover what's gone on for over the last about a year or so, whatever, but mainly want to show you how the more recent months compared to what has been happening in the past. All right, so as a reminder, the data source are right here, Institute for Supply Management.org. You go to these exact URLs here to pull up the more detailed reports. I highly encourage it for anybody who has any interest at all in any kind of investing. There's a lot of great information in there that give you a lot of good clues. Okay, I'm only going to cover just the real basics on what might interest those of you who invest in TSP and index funds. All right, so moving on here, there are two sides of this. There's the manufacturing sector and there's the services sector. The manufacturing sector covers about a third of the U.S. GDP, and the services sector covers the other two thirds. So I'm going by with the manufacturing sector. It does tend to show us give us a better overview of what's going on with the broader economy. Oddly enough. Because basically, there's a saying that so goes as goes the manufacturing sector, so goes the economy. Same with transportation industry and other stuff. So, if we get a good idea what's going on here, we should have a pretty good idea what to expect from the broader economy. In other words, what that's telling us. Okay, these are the responses that some of the industries or participants in the industry have given over this last month. Again, there's a whole, as we've been seeing over the last quite a few months, lots of talk about tariffs. Uh, so, yes, tariffs are impacting business to a pretty good extent. Let's just hope it doesn't last too much longer and that some kind of trade agreements can be made and these tariff issues can be resolved and kind of stop becoming so much of a headwind for economic growth. But you see, you had at least two tariff comments here. Transportation equipment sales continue to decline, volumes are off, and profits have not decreased in proportion to sales. Higher margin vehicles continue strong sales, but low to mid range sales are down. So that's kind of more of a not great but not bad uh, indicator there. If you ask me, it's high volume, higher margin vehicles selling stronger. That's a good sign. It's a good thing, but again, some is up, some is down, but it's just another sign of a more not such a not such a strong growing area now of the economy, which I wouldn't expect to happen in a very bull market that's been around for 10 years. But um, the economy has also surprised us quite a few times. Again, food, beverage, and tobacco products. Sales remain strong, labor remains tight. Tariffs are having a significant impact on cost of goods. No impact on where we buy our food. So there's 3 out of 4 comments so far that are talking about tariffs. Businesses continuing to grow and expand is miscellaneous manufacturing. That's not a bad thing there. Pressure for driving out costs has increased significantly, and the company is facing major changes over the next several years to remain cost competitive. So 3 out of the first 5 comments said something about tariffs. Now, on the other side, we got here. There's a fourth one. Whether the country has slowed construction and infrastructure projects, that's something to consider here. When we see this going on here, we also have to wonder how much of this weakness we're seeing in the overall numbers that you're about to see actually has something to do with weather. There has been a lot of recent talk over just within the last week, actually, about how corn crops are way down right now because of all the flooding in the Midwest. And I've personally seen the flooding as I drive around the country. I've been through Missouri and Nebraska at least 2 or 3 times in the last few weeks. Business continues to be very strong. Our company and our supply base continue to be challenged getting manpower for production. Key commodity costs like steel have continued to come down. Lead times have stabilized after moving out 2 to 3 times. So yada yada. All right. So here's another comment about tariffs and general slowing due to inventory correction. So you see a lot of concerns about tariffs overall, but otherwise, yeah, it doesn't really look like a bleak economy, but it doesn't look great by any stretch either. So, I mean, there is growth that's there. It's just definitely not widespread and very optimistic from what we can tell. All right, moving on here, though. Let's looking at the raw numbers here now. As a reminder, I do change these numbers to something that's a little more fitting for the way I present than what the ISM actually puts out. What their numbers are is in terms of percentage. So this PMI number, which is the overall number, the overall sentiment, 2.1 on mine. It's actually 52.1% of the companies that are, the businesses that responded to the survey are reporting a sentiment of growth. So slightly more than half, but now again, it's very common where the sentiment that gets mentioned here is it's never as strong as what really, or it's not as exaggerated as what usually actually shows up in the quarterly earnings reports of the S&P 500 companies that I also look at. But they're color coded here, as you see. The more red it is, the worse it is. So as you see, there's a lot of red here, but ultimately, more so, what we want to see is numbers above zero as far as my presentation is concerned. Or if you're looking at the ISM numbers, something above 50 is ideal. Uh, so there is still growth here. It is, definitely the last 2 months have been the worst that we've seen over the last year and a half. That's not a good thing to see, but it is still growth. New orders also very weak. It was actually worse in December, and it got better in the first quarter, but it's back to weak. But at least it's still on the increase at the moment. So again, there's still some positivity there, but it's not much. Productivity is down, or it's climbing, but very slowly. It's actually the slowest rate in the last year and a half. Employment also is on the lower end. Supplier deliveries is the lowest number we've seen over the last year and a half. Inventories are they're growing still, but very slowly. This is upstream inventories basically, but downstream inventories they're down, but they're actually not growing. They're not going down as quickly as they were previously. So, is that a good thing or a bad thing? Don't know. It's that could be a sign of less demand on the downstream end, to be honest with you. But it could also mean that suppliers are getting more efficient, or transportation could be getting a little bit more efficient about getting things caught up on that side. Okay, now prices. You see a very wide range of companies reporting price growth in 2018 or 2018, however you want to say it, but 2019 is a completely different story. Very, I would call this mild to moderate. Oh, actually, more on the, a little bit more on the mild side of positive price growth. That's going to be a damper on inflation data more than likely. And as we have seen, recent inflation data has shown that it was a bit weaker than desired. So that's just it goes hand in hand with what we're seeing here. Backlog of orders. This is the first time this month that the backlog has actually declined. Again, that makes me a little bit more concerned that there's some demand issues going on there, and how much of it's tariff related and how much of it's other things going on. That's another problem, another question that needs to be answered. New export orders. Still generally weak over the last several months, but at least it's not down as it was last month. It's still on the weak side. Only 51% of the businesses are reporting an increase in exports. So, That's not so good for GDP data, and on top of that, it also means less demand for U.S. products from customers that are outside the U.S. So again, that's a sign of a global economy. It's not on the best of health right now. Imports also, as we see, the last 2 months they're down. That's also a bad thing because now imports, this being down also, I think it gives another impression that demand is down in the U.S. as well. And if we're not looking outside to foreign sources for supplies on things, then then the rest, the downstream demand is probably not there, and it's increasingly showing more that domestic sources are probably adequate to meet our needs, and also, or it also means that we're not putting enough demand on foreign economies for raw materials and stuff that we might need from them that we don't have such great access to domestically. And then positive and negative growth. The breadth here, as you see, is also down to 11 positive and 6 negative out of 18 total. So there's one industry that's not reporting growth or contraction. So we have seen that number back in December, but it's generally speaking, these are not the greatest numbers to look at. These are the kind of numbers you would expect to see when the economy's at or near a long-term top. To be completely honest with you about it, I don't want that to be overly alarming though, because it's not always. It doesn't all just because you see numbers like this doesn't mean that we're about to fall into recession and have bear market conditions. So it just means we got to keep watching, keep our eyes out for other signs of problems with the economy, and like I say, hopefully the some trade issues get dealt with, the tariff issues get reduced or removed, and get rid of some of these barriers to continued economic growth. Okay, now as far as the center services sector is concerned now, again, another 10 responses here. There's still more talk about tariffs. Um, but finance and insurance, local economy is doing very well, except for a large number of suburban office vacancies. Okay, office vacancies, that is a concern. That is, if the offices aren't being used, then I would start to wonder if it's going to start showing up in unemployment data sooner at some point in time in the near future. But local economy doing very well. That's at least comforting to an extent. Okay, healthcare and social assistance. There's added pressure to find operational savings so we can reduce the cost of healthcare, be a model to others and pass savings along to patients and members of health insurance business. Accommodation and food services. The economy is good and it's showing in our weekly sales. Tariffs are affecting some, but does not seem to matter. Our prices are up as well as costs, but sales are good. If anything, this response right here is the one good thing that makes me feel a lot more comfortable about everything that's going on, because um, discretionary industries like accommodation and food services, they are very sensitive to changes in the economy. And when people start losing jobs or their money starts getting tight, or they can't afford to, to go out on leisure tour trips or eat at restaurants so much, they're going to stop spending there. So those areas tend to be hit very early when the economy starts to go bad. So when we're actually seeing in that companies in that area are still seemingly positive, then I would say that's we're not close enough to recession or bear market conditions for me to overly for me to be overly concerned. Okay, low unemployment is good since our business is entertainment and relies on discretionary spend. Again, discretionary spending. People have to have money to discretionary spend, and this is more evidence that people do have discretionary income to work with, and they are spending it. So those are still positive. Like I say, wait till we start seeing the unemployment rates start to go back in the opposite direction, and more signs that there are problems with discretionary money available. before we really worry too much about what's going on with the economy. Okay. Um, we look at you can look at the rest of these pause this if you want. No problem. I just want to keep this moving along though. On as far as the services data, yeah, it's still generally on the weaker side relative to what we have seen over the last year and a half, but it's not nearly as bad as what was showing up in the manufacturing data. The 6.9 or actually 56.9% NMI or non-manufacturing index number overall is that's not bad. Actually, it's moderate growth. It's just it looks weak because it's weakness relative to what we have seen over the last year and a half again. But is weakness as far as economic weakness, that is not even close to the truth here. Business activity 11.2. That's actually in the mid range, not weak, not strong. So that's a good sign. New orders still on the somewhat weaker side relative to what we're used to seeing over the last year and a half again. But again, 58.6%. That's actually a very good number. Well, I would take this number every month of the year, to be honest with you. So this is all promising information here. It's not as strong growth as it was last year, but so be it. This is plenty healthy right here. Employment also up looking very good at 8.1 or 58.1. Supplier deliveries is the first month that they've been down, and it's down by 0.5%. But we'll just keep monitoring that. We don't want to see it continue to trend downward, but we can. There are some times where these numbers are just transitive issues, and you got to watch for 2 or 3 month or even longer periods to confirm whether there's anything to be concerned about there. The inventories though are up again. That's also makes me wonder if the demand is softening and how much of that demand is from tariffs, how much of it's from weather, and whatever else. Just more of a to be continued. Just keep watching the situation there. Prices still growing, but obviously growing more at a lower, or well, not the breadth at least as far as how much of the industry is reporting price growth. Not so strong anymore, but it is still there. There's still inflation to be had. Just like again, it's how well is this going? How much is this going to impact what the Fed is looking for, which is right around the 2% per year rate? I don't know. New export orders. It's at 55% or 55.5%, which is down from last month, but is actually still generally stronger than what we've been seeing over the last 6 months. So that's a good sign. So this is another indicator of there are problems with the economy in some areas, but there are reasons to be upbeat still when we see these numbers. 55.5 is still moderate growth again, and there's still demand on the global side. Imports though are completely at flat, no growth, no contraction. So that's a concern. But as we see in February 2018, we had the same number. We also had barely at 51% or one plus one in October. So it's been kind of all over the place here, to be honest with you. So as far as one single month, it's not telling us enough here. Especially over when last month was actually a very positive plus 5 or 55.0%. Okay, lastly, second to last year, inventory sentiment 8.5 is for 58.5%, basically plus 8.5. Still looking pretty good. Like I say, it's about average. It looks like maybe on the lower end, but these are all good numbers. It's low, but it's again relative to what standard. This is a very high standard that it's comparing against. So not enough to really tell us that there's anything really wrong there. And lastly, here the positive and negative growth. Out of 18 industries, 16 are reporting positive growth still, and only one is reporting negative growth. Again, this is it still looks very upbeat here. It's very consistent with what we've been seeing over through the for the rest of the previous 17 or so months. So overall, uh, it still looks positive as far as these reports are concerned. We do have a lot of concerns about what's going on in the manufacturing portion of their sector as a whole, but overall, the broader economy looks like it's in okay shape, and I wouldn't worry too much about recession being in the absolute near future or bear markets either. Now, if there is a bear market, it could still happen, but there's not enough any really good justification for one to come, is what I'm getting at here. Just like what happened in fourth quarter of 2018, we did have bear market conditions on the small cap side, and almost bear market conditions on the large caps, but they did recover within pretty quickly, and the large caps even saw new record highs not too long ago. So it's a positive sign, and I do expect to see more record highs in the coming months. So it doesn't mean I expect it to happen today or tomorrow or next week, but within the next several months, I do expect to see more new highs reached. Okay. So don't be excessively concerned. Don't put all your money into the G fund. If you do want to safeguard some of it, go to my announcement post in the Facebook group and follow the diversified distribution in there if you want, and check for keep monitoring for possible changes to it. Right now, my suggestion is still at 75% stocks and 25% bonds. Now the F fund has performed pretty well lately, but I would say be very careful about putting money into the F fund now, because we've seen a lot of the fund. Although the fund has performed very well recently, it could be that people are um, baking in expectations that the Fed is going to drop the interest rate. So by the time the Fed actually does drop the interest rate, like I say, the prices might already be baked in, and the F fund might not really do much more from there. So I'm not saying don't invest in the F fund, but I would say do so with caution that this could happen. And if the price is already baked in, then it might flatten out and not do anything for you, and possibly sell off. Basically, and the price could drop on the F fund. Uh, as far as CNS funds are concerned, those are still my favorites. Those are still where I would put my money. As you know, I'm still 100% S fund myself. Deb is still at, what was it, 65C and 35S. Neither of us has any plan to change anything about that at all. But for those of you looking for any kind of advice, I would look at any combination of CNS fund primarily. If you can handle 100% stocks, you should be just fine still long term. Any combination of CN or S funds again. But like I say, if you want a little bit more safeguarding from the volatility that comes with stock prices, then I would recommend the 75% stocks, 25% bonds for now. And keep your eyes on future posts for possible changes to that. As S&P 500 earnings data and bond yields have a lot to do with what my numbers are. And actually, with bond yields having continued to creep lower and lower, it actually makes stocks look better and better. And I haven't seen any declines on the stock earnings expectations. So actually, they've actually been more positive than what I expected this quarter, and the forward projections are actually inching their way up still. So those are still positive. So there's more reason why I still like stock funds, and they can still focus on the CNS funds primarily. Okay, that's all I have for now. Feel free to comment, ask questions, whatever. Should always be good information for you there, though. Okay, thanks.